All right, enough of the Rolling Stones. Welcome, everybody. 8 people. Excited to have you for our weekly open office hour. We're doing a little bit of a different format. Thank you for joining us on Run the World. Denise and I use this a lot for other meetings that we've had and really love it because it has some fun features like the group selfie. Right now you're going to get prompted to take a picture, and everybody please accept the prompt, and then we'll get a group selfie of everybody that we can send around. It also has a really fun networking feature, so Kevin, everybody will be able to see your face, and everybody else in just 15 minutes or so. We'll talk about a few things and then switch to the networking, and it's a one-on-one networking. Okay, only 2 of you took the selfie, so 3 now. We'll wait for a couple more people to take the selfie, and then we'll get started. Come on, people, selfie. 4 people. Who else? We have 9 attendees now. 5 people don't like selfies. All right, we're at 5. Awesome.
Come on.
People are shy. All right, we'll get started. Something else that we're doing, we've been reaching out to a lot of you to just get more feedback. I also sent around a quick survey, and we actually got a couple of responses here of issues, challenges, ideas, news that folks might have. So we'll start with that, and if you're on the call and would like to identify yourself, please do. Otherwise, I keep it anonymous. But one of you says she or he is challenging issue around a migration of a variational quantum eigensolver-based algorithm to a D-wave binary quadratic model, and how to get that model running on D-wave, and if anybody has any advice on how to do that. So anybody here on the call, please, and I'll end the group fee. We have 6 people now. If you have ever executed a VQE on D-Wave and have any experience with that or any thoughts, please speak up either in the chat, or there is a grab the mic feature at the bottom, and if you grab the mic, we'll include you here in the chat. Anybody have any experience with doing this? Variational quantum eigensolvers on D-Wave? Terrell says not yet, no.
Come on, Terrell, you have 2 PhDs. You should have this.
Well, we'll definitely get that message out to all of our members, and Denise and I will see if we can find somebody else that can help with that question. Amen, no, neither, but that's a good question. That's the kind of feedback that we love to hear. So we'll find an answer for you, and we'll get back to you. We have a little bit more here. A second point was, somebody just sharing the news that they're finishing research on some applications and use cases, especially in financial services. Would love to hear more about that. What kind of use cases and what kind of applications? Obviously, financial services is something we all work with a lot. So again, if you're on the call and would like to talk about it a little bit, feel free to grab the mic and we'll patch you in here. But that's great to hear. And then there was a third item, a third response from one of our members. And Denise, this is for you. One of you says they completed the configuration and setup for CQC ticket. And
I know who that is.
And reviewed all the computers available to generate the code. They advanced in the work with D-Wave Ocean and learned that it is not available on Ticket. So I think the ask here, and again, this is anonymous, but Denise will make sure that you get to respond to that. I think there's a request here for having D-Wave Ocean on CQC Ticket. Denise, you sound like you're familiar with that.
I'm asking right now, and I'll have an answer tomorrow.
Awesome.
So the mystery person, reach out to me and I'll have an answer for you.
Perfect. So we appreciate that feedback, and we'll send around this 3-question survey that literally takes a minute or two to fill out every week. If you have any challenges, any news, anything to share, just do it there. We'll do it anonymously, and we'll get the answers for you, however difficult it might be, but we'll get it done. So we also did a survey a couple weeks ago about what your challenges and priorities are. And one of them was fundraising. That was one of the top 3 challenges and issues. So we'll just talk about that for 10 minutes or so. Then we'll have an open Q&A session for a couple of minutes, and then we'll move into the networking part that we're all here for. So let me share my screen. Fundraising. Everybody is busy with fundraising, it seems. I actually spoke to one of you today who said they are raising 2 to 3 million. And that's a conversation that I have pretty much every day. Everybody is fundraising. So I just thought, I've been fundraising for 10 years for different startups. I've raised tens of millions, but now I'm also an investor, and I work with a lot of investors. So I thought I'd share a little bit of the investor perspective and what investors look at and how that really works. For me, that certainly was very mysterious when I was a startup founder. So hopefully this will be helpful. One point that I want to make here at the very beginning, and this is an article that's a couple of years old already, but they looked at 5,000 cap tables. Hopefully everybody is familiar with cap tables. CAP stands for capitalization. So this is a table that keeps track of the capitalization of your company. How many shares do you have outstanding? Who owns how many of those shares? What are the terms, valuations, vetting periods, and so forth of these different shares? And that kind of dictates not only who owns and runs the company, but who has what kind of potential to make money down the road. So an analysis of these 5,000, and I'm happy to share this article, cap tables showed that, and this is a really important point, that founders typically end up with somewhere between 11 to 17% of equity of the company at the Series D. So if you go through a few fundraising rounds, a lot of you have done seed or A rounds or currently in our A round. So if you do a couple more fundraising rounds, founders on average will have between of the equity. If you're more than and you have divide that by 2 or by 3, or I know some of you have up to, and you're really not left with a lot. You start math, you own 7% of the company 5 years down the road, and you're at a certain valuation, let's say 300. Money is worth 15 million. On those 15 million, you're going to have a lot of terms. You might have 1-year cliff, you might have a clawback, a lot of different terms that make the ownership and those 15 million in this scenario even more challenging and more difficult. So this whole idea, and this is a conversation I had with people over the last two weeks, this whole idea that founders get rich through a startup is statistically, and we all can debate what means rich, but it's not that obvious. So over a period of 5 to 10 years that you will need to get to this, on average, this type of amount. You have terms, conditions, clawbacks around it. You have to pay taxes, and that is your income for this 10-year period. Knowing that you've suffered through a lot of challenges as well. So certainly, it's not like everybody is getting rich. It's really something that is often misunderstood by founders, and very, very important that you need to be aware of it, and you really, really need to hold on to that equity. To even just have a chance at success here, every little percentage point counts, and you really need to hold on to your equity. Don't think that by giving away 5%, 2%, 3%, it doesn't really matter. Every percent counts.
André, I have a question around that. And a lot of times startups will want to give away equity rather than paying someone to do a job. What's your advice on that?
I think that's a horrible idea. Exactly for this reason, and I'll send around the article that kind of breaks down how, on average, out of these 5,000 startups, you get diluted from 100% to ultimately these 11 to. But equity should be reserved for really only the founding members, or very, very common that when you start to scale, you give some stock options that have different to some of your key employees, but that really amounts to only a couple percent Class A. So I really would encourage you not to do that. The other reason is called for 3, 4, 5% to actually make money with it. Again, for the same reason, even on that equity and worse terms. So it actually also doesn't make sense for that employee many times. And you're better off paying them a salary, paying them bonuses, commissions, milestone payments, and so forth. So this is kind of the first step when you think about fundraising. And the moral of the story here is fundraise as late as you can. Try to get revenue, try to get partnerships, try to get grants, bootstrap it, max out your credit cards. That is what entrepreneurship means. But don't perceive fundraising as success. You're not a successful startup because you raised 10 million, 50 million, or 100 million. It's quite the opposite. The second point is that then you have to understand the market a little bit. And what I mean by that, you need to understand the size of the market to really identify who might be interested in it. And the quantum tech market, you see some of the revenue is very small. Forecasts of it vary widely depending on the assumptions that you make. It is still, compared to other markets that investors might invest, very small. So you're only going to attract investors of a certain type, a certain reward preferences. So investors make their own investment decisions. Every professional investor has a mandate, unless they're actually truly investing their own money, which is very, very rare. But they are bound by bylaws, GPLP agreements, and so forth. So really understand that market and look a little bit at where your investors are coming from, where that money is flowing. And here you see a chart of all the investors so far in 2020 for Q1 and Q2. You see the names, you see what categories they come out of: early stage versus seed versus angels versus venture capital. And by looking at that, all of a sudden you're really narrowing the market. And the pot that you can grab into to get 2 million, 3 million, 5 million, 10 million, all of a sudden becomes a lot smaller, which is a big problem. but it also becomes a lot more focused and well-defined, which is a big opportunity. So fundraising is not something that you do with the garden hose and hoping to get lucky, and we'll look at that a little bit more in a couple of minutes here. It is really about matchmaking. It is really about understanding what type of investor might be interested in the type of market based on the fundamentals that you operate and that we all operate in within quantum, and who these investors are. And those are the relationships that you then need to really be proactive about on a continuous and ongoing basis. You probably all have a lot of experience by now building pitch decks. Here, this is just hygiene. Investors are impatient, short attention span type of people. So when you throw them a curveball, so sticking to what they expect, which is this kind of, how can you mitigate the product risk? How can you mitigate the market risk? How can you mitigate the competitive risk? How can you mitigate the financial risk? How can you mitigate the execution risk? And how can you mitigate the exit risk? Those are the typical metrics that an investor will look at. If you give that to them in a pitch deck, organized in the way that they are used to seeing it, and they will look for a number of very certain specific things here in terms of the structure, the content, the language, and the data that you serve up to back this up, the higher your chances of success. And this is something that I'm happy to send around as well, small to even read, but just as slides that people are used to seeing. And when you're fundraising, that is not a good moment to be kind of fancy or different. When you're fundraising, you're asking other people for money. You really want to make sure you play to their strengths, their expectations, and deliver on the formats they are looking for. Beyond slides, people more and more use modern technology, and that is something that I'd encourage everybody to do. There are some really great tools out there, like startuprunway.io, for example, which models your cash flow. Hopefully, all of you have spreadsheets with you have 1 million in the bank or $500,000 for your expenses, and you model your cash burn, what's called the runway. And those spreadsheets are great, but there are tools that now are a lot more visually pleasing, collaborative, and allow for a lot more filtering, sorting, and other features, as well as this modularity of adjusting your projections. That again makes it a lot easier for an investor to understand what you're doing, understand your projections, and ultimately believe you. This is all about being credible, taking this risk away, the product risk, the financial risk, and so forth, and ultimately moving that investor relationship forward. Another example here is captable.io. We talked about these cap tables. This is an example of one of my companies. I'm 100% owner, so this is not very exciting to look at, but you have the same type of application, and both of these are free tools that just allow you to manage it online, collaborate around it, make your projections, make your forecasts. The next point, and second to last, is this question of how do investors make decisions, and this also is very important to understand. Investors very, very rarely, and this is a Medium article by a big venture capitalist, very rarely invest into incoming deals. I spent many years pitching investors, looking them up on LinkedIn, going to events, meetups, conferences, sending them cold emails and saying, hey, this is my cool company, do you want to invest in it? If you look at this breakdown of this very specific venture capitalist, they invest in only about 12 companies. Over are companies that come out of their own network, that come by recommendation of other investors, or that come by recommendation of existing. So investors have a very, very strong herd mentality. They really like to stick to their own networks because it gives them a sense of security. And this is very, very important to understand. Fundraising is very, very difficult. If now you're in this bucket of 12 or late stage 7% of companies emailing dozens or hundreds of investors and hoping to raise money like that, then you're in a very, very difficult position. I am helping to raise 60 million euros for a European quantum computer right now. On the day we started this effort, 52 million was subscribed, and those 52 million were subscribed by existing partners, customers, and investors. The other 8 million is what we needed to raise, and we've been working on that for 3 months now, and it's still not easy. It's still taking a lot of time, despite a tremendous network that we have, a lot of experience, a lot of credibility. It is still very, very difficult to fill that gap. But the vast majority of that round was filled on day one by existing contacts, existing investors, existing partners, and customers. A dynamic that's very important to understand. Here I'll show you a tool that investors use, and this is my own personal profile. Signal is like a Match.com or Tinder for investors, and all the big investors are on here. You see Tim Draper is one of my connections. So you build out your investor profile, you post your deals, you post your mandate, what you're looking for as an investor, and then this matchmaking happens. And beyond phone calls and emails between people that know each other already, this close allows to create this and really find what they are looking for.
Hey, André, you're breaking up a little bit.
Okay.
Just FYI.
So as a startup, you have to play to this as well. Many times investors will refer to websites like AngelList at angel.co, Crunchbase, or PitchBook to look at companies. So these are the places where, as a company, you really want to have a profile and be present, because that's where in these networks referrals are being made. So this is really kind of the place that you want to be. That's kind of it. A lot of these thoughts are in our OneQuantum community under the fundraising resource tab, written up here a little bit, and then we have some of our investor contacts, 4 pages of investor contacts to help you get started. But any questions, any thoughts on this? We'll take a few here now before we start the networking. Otherwise, just reach out to us.
I think the other point I want to talk about is non-venture capital money from family offices or angel investors or corporates. And that's something also to consider when you're going for money. Now, I see Kevin has requested the mic. André, how do we give Kevin the mic?
There we go. Kevin, you should have the mic.
There you are. Hey,
okay.
Kevin.
So I finally know that my camera is pointed correctly at my face. So my selfie turned out hopefully to be halfway decent. Thank you. And actually, Denise, your comment was timely because that is part of my question. And if I could ask maybe a couple of questions just so that I don't have to keep asking for the mic again. So we're a one-year startup. I think we're similar to many quantum startups that are not at that stage, like a CQC and others that are raising millions and millions of dollars in seed capital or Series A. Our goal is to seek, in part for disciplinary reasons, if nothing else, is to seek outside capital so that we can continue simply to do our fundamental research. Our interest is creating breakthrough research, and we know it's going to take time, and we know we're not going to, although we are pursuing revenues and clients, we know that that's not going to be enough to sustain us for a traditional venture capital investment. We have to have breakthroughs, and we need funding to hire people to achieve those breakthroughs. We prefer that investment not to come from a VC, but to come from an angel investor, someone who is patient and someone who really understands our business. So that's my first question: is how do we position ourselves for that type of investment?
Yeah.
So that positioning would involve perhaps structuring our company in a certain way that would make that investment, that would facilitate that investment. Perhaps creating, we're a company, but we don't have a board, for example.
Yeah.
And we have not issued. We're not a public company. We haven't issued stock. So how do we get started to position ourselves for, one, angel investors, and then two, perhaps within a few years of seed money or Series A money, and so that we can show that we have the right corporate structure in place for whatever investments might be offered to us.
Great question.
That's my first question, André, if you don't mind.
Quick, make the second one quick, please, just because we're running out of time.
Okay, then we'll just leave it at that. If you could respond, thank you.
Yep, no, great question. And every stage of fundraising has different structures and different priorities, right? You start with what's commonly called the 3Fs, friends, fools, family. And that's just you having a nice smile and going to your friends and sending them a nice email, and really nothing more. And then as you go down from stage to stage, the more professional it gets. An angel investor is not going to look for a board. They might request that you create a board and give them a board seat. They are not going to look so much at projections. They are less concerned with legal structure. They are really more concerned, and you use the word positioning, with the promise, your vision, your mission, your story. Do you have an MVP? Do you have maybe an additional partner that you're running a project with? That is what angel investors are looking at, right? So that's what you need to play to. And then there are bigger angel syndicates, which become a lot more professional and behave like venture capitalists. And then you have the venture capitalists that we focus on a lot right now. So the mechanics of what we just discussed are the same. You have to understand who these angels are. A lot of them are organized in groups. The New York Angels. I live in Miami. The Miami Angel Network. So you have to understand who they are. They too have a mandate of what fields, what regions they're investing in. They have a mandate in terms of check size. So again, you really need to focus it down to that core group of angels that actually meets your mandate and that can invest into you. And then you need to build that relationship. Angels are a lot about relationships, and a lot more about this cold outreach compared to venture capitalists, because they don't have those professional structures and the same kind of large network and tools to manage that, right? So those are some of the differences between angels and VCs. And if you want to give me a call later this week, happy to talk more about it.
I think we're running out of time. Otherwise, I would talk about corporate investors.
Yep.
One of the things that I see a lot of is as you pitch to companies, if you can gain traction with their, certainly in quantum, they're looking at the innovation team. If you can gain traction with the innovation team and they feel that you can contribute to a project or to the future of the company, what I often see is that the company will consider co-investing along with doing an engagement with you. And so your kind of offering has to align with their strategic priorities. And when you do that with the big corporate, what I find is that often gets you a discussion with their venture team. It doesn't guarantee you that they'll invest, but that is another way to get money. And they are a little bit more, it's not VC, it's a little more speculative. They're investing what they feel to develop long-term solutions for their companies. And so that's another thing to consider as you go for investors to go after the corporates. And I think you're agreeing with me, Kevin, so that's good.
Yep. Good.
Yeah.
So, and any more investor questions? That is a topic that came out a lot. Put it into the weekly survey. Put it onto the chat online, or send Denise and I questions. We'll move on to the networking session. So we'll close this session. Just go back to the agenda item. I'll post the link here. Join the cocktail hour, and that's going to match all participants one-on-one for a 4 or 5 minute conversation. So a fun little networking event, and you can join as many or as few as you'd like. We hope to see you there. Sometimes it takes a minute or two to match you with somebody, and it's really come as you go. Thank you for showing up today. We hope to see you next week. And